Hey guys, welcome back to another video. If you all are new here, my name is JJ, and in today's video, I'm going to be doing a very basic understanding of how you guys can sell call options, also known as writing covered calls, for weekly or monthly income. Now, I'm going to jump right into this thing, so if you guys find value in this video, if you could do me a huge favor and hit that like button, because that really does help out the video and the overall channel. So in today's video, I'm going to be using my Robinhood portfolio to help me explain this and make it a little bit easier for you guys to understand on how exactly you can sell call options or be writing covered calls. Now, before I jump into an example, what exactly are selling call options or writing covered calls? Basically, what this means is that first is you have to own at least 100 shares of any given company that you want to sell a call option on. Once you own 100 shares of any given stock, you can then write covered calls or sell call options on that stock. And to really simply explain this, what this means is right now Tattooed Chef is trading at $18.21. And let's say my average cost was at $18. So I own 100 shares at $18. And then I say to myself, you know what? I'm okay to sell those 100 shares if Tattooed Chef ever got up to $20. Well, then you can write a covered call with a $20 strike price saying that you are willing to sell your 100 shares at the $20 strike price if Tattooed Chef ever gets up to that $20 price. Now, if that sounds really confusing, don't worry. We're going to jump into a step-by-step process of how exactly to do this and what each step means using the Robinhood app. Now, before we get into the next step, I do have a quick message from today's video sponsor, Vaulted. So I hate to break it to you, but that cash you have tucked away in your wallet is losing value as you watch this video. Especially in the times we are living in today with inflation on the rise and the feds keep printing money. Holding real tangible assets is a solution for unstable fiat currencies, and one way to maintain the purchasing power of your money is through gold. One of the best ways to purchase gold in today's age and add it to your portfolio of assets is through Vaulted. Vaulted is the mobile platform and app that allows investors to purchase physical gold. The best part is when you purchase your gold on Vaulted, it's not like you're just buying a piece of paper that says you own gold. You are buying actual pieces of gold that is stored at the Royal Canadian Mint, or the best part is you can have it actually delivered right to your home. It takes less than a minute to set up your account, and Vaulted offers the lowest transaction fees and features the best cost structure in the industry. With Vaulted, buying or selling gold is as easy as buying a stock. There is even an automatic savings program called Vault Plan that investors can set up to automatically purchase gold every month. If you are interested in adding gold to your portfolio of assets, make sure you click that link down below in the description to give Vaulted a try today. There are no minimums to invest. So now let's look at an actual example to not only help explain this a little better, but also make it easier for you all to understand. So again, like I was saying, first, you need to pick a stock that you own at least 100 shares in. I own 200 shares in Tattooed Chef, so I'm going to be using this for today's example. So the first thing you want to click here is you want to click this trade button down here on the bottom right, and then you want to click trade options. Now, real quick, some of you may not see this trade options button available, and that is because you have to actually go into your settings and you have to enable options trading in Robinhood. So once you've enabled options, you can click this trade options button here. And then what you see up top is, I would just honestly kind of ignore this discover page. I would look at these dates up above here that you kind of see going across the screen. It says today because today is an expiration date, and then every other date after that is what is known as an expiration date. So we're going to look at expiration date November 12th. So the first thing you're probably going to see is buy call. You need to first, to set up this trade correctly, you need to make sure and double or triple check that you have sell and that you have call selected, because there has been times that I've been in a hurry and I have had buy selected and I wasn't paying attention and I went ahead and made a trade and I accidentally bought a call instead of selling a call. So when I did that, it was just everyone's going to make mistakes. Just make sure you take your time when you're doing these trades, because it is very easy to skip a step and mess something up and do something you really don't want to do. So what we're going to select here is make sure we have selected sell and then call. And then what we can see here are these strike prices, these numbers on the side here, this $18.50, $19 call, $19.50 call, $20 call. And then also below the current share price, you see the $18 call, $17.50, $17 call. Those are all strike prices. So this is where you choose where you are willing to sell your 100 shares. So to go back to that first example, what I was talking about, this is where you want to choose where you are willing to sell your 100 shares if the share price would happen to hit your strike price by expiration date. So we're going to use that same example of the $20 strike price. That again means that if I make this trade and I use my 100 shares as collateral to earn this premium, and we'll get into premium in a second, that means I am willing to sell my 100 shares at this $20 strike price if by November 12th, the share price of Tattooed Chef is at $20 or higher. Now, there are chances that you could get assigned to sell these shares before the expiration date if it is so far above the $20 strike price. But for now, to make this example pretty easy to understand, we're going to keep it that if the share price is above $20 by an expiration date, which is November 12th, then you will have to sell your 100 shares of Tattooed Chef. And don't worry, you're not going to have to actually go in and make the sell yourself. Robinhood will automatically execute this for you, and they will automatically sell those shares for you. So here's kind of the benefit with this. So if you own the shares and let's say your average price was at the $18, right? Well, then now that it went up to $20 by November 12th, well then cool, you're now selling your shares at a profit. You're selling your shares at $20 whenever you had an average price of $18. Then you would have automatically made a $200 profit in just the capital gains on the price increase in Tattooed Chef. But here is where the cool part comes in, and how you can really earn this weekly and monthly income is what's known as premium. Now, I mentioned this earlier, but these red dots over here, these red buttons, are either going to be red or green depending on how they are up and down or down in price. So you can see for the $20 strike price, there's one that's 38 cents. So if you click that, this is where you actually make your trade, and this is how you set up your trade. So the first spot up here, it says sell TTCF $20 call 11/12. So the 11/12 is the expiration date, and it says times 100 shares. So one contract is what this one here is for. Every contract equals 100 shares. So if I would be wanting to put a 2 in here, then that means I would have to own 200 shares in order to make this trade. But since we're only assuming we have 100 shares, we're going to put in the number 1, and then we put in the limit price. I usually go right in at the bid price if I know I'm comfortable with making that, so we'll keep that at the 35 cents. And then now this says minimum credit of $35. So what that means, right? So this limit price here, that premium that I was talking about, the 35 cents, that premium is a cost per every share that you're using in this trade. So since you're doing one contract equals 100 shares, 100 times 35 cents is $35. So as soon as this trade gets fulfilled, as soon as you click review and then swipe up to submit. Now I'm not going to actually do this trade today, but the last thing you need to do to submit this is to just simply swipe up. Once you do that and the trade goes through, that $35 will show up in your cash account right away. So when you go back to this main menu here, how my buying power says $4.68, we would now add $35 to that. So that would be $35 more because you placed that trade. So that is basically how you can sell your first call option. Now, what are some risks here? What are some things you need to keep in mind and things you need to look out for when you're doing this strategy? So the first thing is that you need to make sure that you are 100% okay on doing this with a stock that you are willing to sell. Now, for example, I own Apple in my Fidelity portfolio. I wouldn't really want to be trading call options on Apple because I don't have any plans on selling that stock anytime soon. I want to hold that stock for the future. So I highly recommend you not do this on a stock that you would feel upset or hurt or, that you really don't want to let go of. Because trust me, there's times out there where these premiums get pretty high, and you're like, oh man, let me just try this out and get this premium real quick, and then that stock shoots up in price, and then you miss out because you're still stuck having to sell at your strike price. Now that's something to keep in mind here. So the reason I say only do this on stocks that you are willing to sell is because another risk factor here. So let's go back to our example of placing our trade with this $20 strike. If we would do that, and then by November 12th, Tattooed Chef, let's say, went up to a $25 per share price. So now we still, at November 12th, have to sell our 100 shares at the $20 share price, because even if Tattooed Chef is way up at $25 or say hell even $30, we cannot sell our 100 shares for that share price because we agreed to sell at the $20 strike price. Now if it stays under the 20, then nothing will happen. So that's the cool part about selling these call options, is that if it stays under 20 and you don't get assigned, all that happens is after November 12th, that option becomes expired, you keep your $35 in premium that you earn for placing the trade, and then that's it. You get to keep your 100 shares as well. So that's what you want to happen. You don't want to get assigned. You want to just place these wherever you feel comfortable if they do get assigned, but if they don't, then you get to keep that premium for writing this contract, and then that's all said and done. You get to keep your 100 shares, and you get to do it again. Now, when it comes to a time frame for expiration dates, I like to do this either on a weekly or a bi-weekly time frame. So I would probably look out to November 12th or November 19th. So it's a little bit more active, but I also don't have to use those shares as collateral as long as I can be more in and out of the positions if I want to. So guys, again, that was a very basic way to understand how to sell call options or be writing covered calls for that weekly or monthly income. If you guys would like more information on this or just to see the trades that I make myself, I place all of my options trades and the stocks I'm buying and selling in my Discord down below. If you guys want to join that community down there, you can join through Patreon, and that gives you access to Discord. I also do want to give another quick shout out to Vaulted. Thank you for sponsoring today's video. And also guys, thank you all so much for watching. I hope you got some value out of today's video and learned something. If you did, please make sure you hit that like button. That really does help out the video and the overall channel. And until next video, you all take care.